In the advanced economy, growth is faltering, and that's reflected in, stock prices are plummeting in the major advanced economies. China's growth outlook looks, pretty challenging. Some other emerging economies are also, in difficulty, Brazil and Russia. And of course, all the oil exporting economy, including the big ones like Saudi Arabia, are under considerable stress. So this cocktail can come together. And so one of the things we do in the survey is to say that perhaps this cocktail could lead to an extreme event. This is not a high probability event, but it's certainly an event which could have a crisis, and this crisis could actually be very unique. It's the first crisis possibly after World War II that could resemble the events of the Great Depression in the 1930s. A series of deflationary competitive devaluations that spread across the globe like a kind of deflationary gravitational wave, to use a recent analogy. It's not a high probability event. But it's something that cannot be discounted, and that's something that India must prepare for over the next year or so. Now, and we have a table here explaining, what kind of form this next crisis might take. If that's the case, then we in India and the world must recalibrate its expectations, because India has become so entwined with the world. It's a cliche, but it's very true that increasingly India has become integrated. And this is a chart that shows how correlated Indian growth and world growth have become. The correlation is about 0.42 in the last 10 years. And this means that if the world slows down, we will slow down as well. And so, our slowing down should not be blamed on what India does or does not do. And so it's really important to calibrate in expectations. And this is, this has been more and more true in the last few years. So, outlook for growth and inflation. Let me just make this clear. There was a typo in the survey and in some of the tweets. So, our real GDP growth projection for the coming fiscal year, 2016-17, is 7 to 7.75%. And there's a wide range which reflects the fact, that the range of exogenous possibilities is also very wide, from a rebound in agriculture, which means we'll be at the upper end of that range, and a full-fledged international crisis, which could take us to the lower end or even below that. And also this uncertainty that's been created by the divergence between the nominal and real growth aggregates, which we still, are fully playing itself out. The inflation projection, it's going to be between 4.5% to 5% below the RBI's target, and we explain why that's the case. The Seventh Pay Commission, to the extent we're going to decide on the implementation in the budget, going to have a minimal effect. There's, rising excess capacity. The private sector is stressed. There's a deflationary world environment, and therefore this is, the risks are all to the downside. That's why the 4.5% to 5%. Now, what are the major risks to this scenario? Mostly global, faltering world growth, perhaps even a financial event extreme, and rising oil prices. Now, one thing I want to make clear is that, if you get faltering world growth and extreme financial events, it's likely that oil prices will decline. So that's some compensating consolation for India. If growth slows down, oil prices are also down, and therefore there's a kind of balance. However, there is a scenario, which is, I think, the worst case scenario, where because of supply disruptions, oil prices could go up and world growth could decline, which would be the worst case scenario from an Indian point of view. Okay, so having said that, let me run through, monetary fiscal policy going ahead. One of the interesting things to us is that, and this is something that's been commented upon, that declines in the policy rate have not been transmitted into bank lending and deposit rates. Why is that the case? And it's interesting that it's not that it's not happened at all, but certainly after the last rate cut in October, this has not happened. Pass-through did happen to a greater extent before the October rate cut, but it did not after the October rate cut. In fact, if you look at the numbers, the total policy cut has been 125 basis points, but the deposit rates have come down only 93, and the base lending rate by 63. And so the question is, why is that the case? Perhaps small savings, and the government is working on that, but the small savings rate cannot explain why there's a change before the October and after the rate cut. Our analysis shows that perhaps what's happened after the October rate cut is that liquidity has been unusually tightened, so that what...
That was Arvind Subramanian talking about the forecast or the economic forecast that came in today.